thoughts about current EU monetary policy and the quantitative easing embarked on by the ECB?
I think if you take a look at quantitative easing around the world, it's been pretty successful in stabilising underlying economies, and clearly it's had a very positive impact on financial markets around the world as well. But I think there's one, QE is no panacea, because in the States and in the UK it's been quite successful in terms of stabilising and creating a more opportunistic and positive business environment, which has allowed then economies to move on a bit more. Whilst in Japan you've had on-off quantitative easing for the best part of a generation and they're still struggling. So what's the necessary required other ingredient? And that necessary other required ingredient is what I would call supply side, and what in reality means flexibility of the economy in order to run with the QE stimulus and go on to sort of new highs and new improvements. So this is why I think for Europe the critical debate is not just should they do QE, which the answer is yes, but why they need to also enact these supply side reforms, labour market reforms, flexibility reforms in order to make full advantage of it and not go down that Japanese route. If they do that, then it's 2 ticks in the box and Europe will move forward.
The result of the intervention is that we've kind of got a rip-off situation for the consumer for the last 5 years. You know, base rates pitifully low, mortgages at 4% AFR. It's a joke. Comment on that.
At a certain level, the individual is probably looking at this and thinking, oh my goodness, so let's get this right. Whilst we've enjoyed lower interest rate repayments and levels on our mortgages and any other debt that we've got, here's the reality: we're not making anything on our savings. And when you look at the economy, or most Western European economies, there are more savers than there are borrowers, and hence net it's not good, and it's not as if wages are going up as well. And so all of these things look bad and poor. But let's think about the alternatives here. The reality is, you know, put aside the reasons for it, but there was too much debt in most Western economies in 2008. Now, partly that was government's fault, from building up debt themselves and legislation which led to other things. But let's face it, everybody likes to consume, and consumers went on a consumer spending boom and hence debt binge, which caused debt levels to get to ridiculous levels. So as a consequence, you know, the old notion of 7 rich years and 7 thin ones is probably about right. And that's as a consequence of what we're facing today. So extraordinary times at certain points a few years ago, followed by some extraordinary thin periods afterwards. My view would be this. The best notion from any personal finance perspective remains you should continue to be saving some money, because that makes sense. You might be 0 interest rate on it at the moment, but by putting money away, paying down debts and saving more money, you're setting yourself up for your medium-term financial future. And that remains still the best advice, even if at this moment in time, you know, you can borrow cheaply and not get any money on your savings. That still remains the most sensible backdrop.
If everyone owes trillions, I still haven't got a clue who anyone actually owes it to. Do you think it's Warren Buffett?
Well, Warren's a very interesting guy, because Warren, of course, Warren Buffett has a whole load of things like catastrophe bonds and things like that, where if he's sort of hedged himself in the sense that whilst he is a big reinsurer and has lots of obviously equity investments and other things going on, he's also got investments where if it all goes terribly well, he actually should also be doing quite well as well. So he's sort of hedged himself. The reality is, where is the money owed? So here, if you want to paint a very negative scenario, you would say that the West, in horrible summary, owes money to the East. Because you think about, who is the biggest, you think about the biggest financial market in the world, the States. Think about the biggest subcomponent of that, which is the US Treasury market. Who are the 2 big, phenomenally big holders of US Treasuries? It's the Japanese and it's the Chinese. So here's the interesting trend. The Japanese are not really buying any US Treasuries anymore because they've got their own problems. The Chinese, by contrast, are buying a bundle of them and have been increasing holdings and will clearly become the biggest holder of US Treasury bonds over the next few years. So why are the Chinese buying US Treasury bonds, which are yielding very little, when Chinese economic growth is somewhat better than it is in the States? And the reason is because, of course, the Chinese at this moment in time want stability, because they've got to sell some goods and services overseas. They don't want the US or Western Europe or whatever falling in on itself, struggling under the debt burden and related. They want these economies to continue moving in some semblance of the word forward in order to sell goods to them, or have that global backdrop which is still conducive enough to allow the Chinese economy to develop as well. At some point in the future that may change, and that is when, as always, in the split between creditors and debtors, it's always better to be the person who is owed money rather than the person who is owing, unfortunately. And the pound of flesh that will be demanded at that moment in time will not be pretty. It will lead to geopolitical uncertainties and lots of volatility. But ultimately, the winners of all of this, you have to conclude, is still that continued shift to the east. And it is those creditor nations of Asia who ultimately do have the whip hand still.
On the back of that then, knowing that the East is potentially got the whip hand, as you say, do you think Europe is still a place to invest money?
Europe is still a place to invest money. Here's the reasons why. You've got huge catch-up potential in Europe still, mainly because the markets there have underperformed and people are very pessimistic about the area, or have been over the last few years. There are still things that European companies do very well. There are headwinds though, there is no doubt about that. You've got negative demographics in the sense that populations are going down, which is not a good backdrop. So therefore what you need to see, or what you need to look for when you're investing in anything to do with Europe, are management teams which are aware of those backdrops and actually are perhaps looking beyond Europe for the generation of their sales and profits. So if you combine that sort of company equity mindset with, from a big picture regional Europe perspective, an acknowledgement that if policymakers actually get their act together, enact some supply side reforms, put some more flexibility into the economies, and use policy measures decided upon like QE in the right way, you do have some catch-up and improvement potential in Europe. But I would say it's more specific, and certainly where I'm focusing on is much more specifically in individual companies which take that varied backdrop on board and then are looking to utilise their particular strengths and their corporate observations on a global level.